We need to clear something up. Everyone keeps saying that high interest rates can't stay this high because the economy can't afford it. And this just isn't the case. I mean, it's sort of true, but not how you'd think. And this has massive implications for how you invest and plan for your retirement. So in this video, I'll help you understand the impact of interest rate hikes on 4 different types of assets. We'll also look at the 5 longer-term implications for your financial plan. And in the end, I'll give you 3 actions to help you see if you're on track and a way to get your questions answered. Let's dive in by talking about what interest rates actually are. Essentially, they're the cost of borrowing money, and they're highly influenced by central banks, the Bank of Canada up here in Canada and the Federal Reserve in the US. Now, in the last 18 months, we've seen a substantial increase in interest rates, more than we've seen in decades. This was intended to stave off inflation. You remember when we were talking about inflation? But it has massive ripple effects through the entire economy. Interest rates can absolutely affect your retirement. The question is, should you be concerned about them? Now, the short answer is no, but there are pros and cons to both low interest rate environments and higher interest rate environments. The longer answer is no, but you need to know what to do with your money in a high interest rate environment. And that's what we'll deal with here in this video. Now, here's the thing. Higher interest rates discourage people and businesses from taking on even more debt. But the nuance here, and why I say higher interest rates don't affect the economy the way that you may think, is that for everyone paying a higher interest rate, someone else is on the other side receiving a higher interest payment as return. Higher interest rates cause pain for borrowers, no doubt, but they also benefit savers. Or put another way, higher rates can hurt owners of assets, but benefit lenders of money. Now, what does this mean for assets buried inside your portfolio? Let's take a look at the immediate effects. Starting with fixed income or bonds. Bonds are investments where you're essentially lending someone or something, a business or a government, some money. When interest rates go up, the yield or the interest rate on new bonds also goes up. It costs these businesses more to refinance their debt. The interesting thing, though, is that when this happens, the prices of existing bonds, they go down. It's an inverse relationship. The bond market is on track for 3 years of negative performance, something that is exceptionally rare. So this is causing a lot of pain, no doubt. Here's the kicker for long-term investors, people who are lending money out and expecting a return back. Although your existing bonds might be worth less today, over the long term, you could actually come out ahead thanks to now earning a higher yield over a longer period of time. When interest rates go to near zero, your bonds didn't offer many benefits. But today, it's a completely different game. Now, what about stocks, equities, or shares of companies? They also react to interest rate changes. Generally, rising rates will squeeze corporate profits. The added interest costs that these businesses they need to carry can be particularly challenging, especially if those companies were heavy borrowers. They borrowed a lot of money. Many of the darling companies of the last few years who were laden with debt, they maybe hadn't produced consistent profitability. They're essentially gambling on the one-way bet that interest rates would go low and stay low forever. It seems, for now at least, that game is over. The same is true in real estate. Here, higher mortgage rates can impact both homeowners and real estate investment trusts, or REITs as they're called. Now, REITs are baskets of income-producing real estate assets, and it makes sense that all else equal, when the cost of money increases, that the value of those assets should decrease due to the use of leverage that operate in many of those different types of properties. I saw a case last week where a person who was hoping to complete on an investment property purchase that would be rented out for $3,500 a month. At the time of the offer, their borrowing costs were going to be about $3,100 a month. It was tight, but there was still a bit of positive cash flow to still cover some of the other miscellaneous kind of phantom ownership costs. Now the deal's been built out, the building's been built up, and they have to go and get the financing in place. They're no longer qualified based on higher rates and the stress tests that are applied on top of them. So they had to go to an alternative lender where their payment will now be $9,000 a month at an obscene rate. This is an absolutely brutal position to be in. The added risk here is that mortgages in Canada, with the exception of Alberta and Saskatchewan, are recourse loans, meaning that if you don't pay off your mortgage in full, lenders are entitled to go after your personal assets to make up the difference, even if you relinquish your home. This is no good at all. Now, the silver lining, especially for retirees and those approaching retirement, typically that paid off much more of their debt, they maybe don't even have a mortgage on their home, is that for cash, rising rates can make them much, much more attractive. As an example, the net yield on the CI high interest savings account today, without any lockup or term that needs to be committed to, is paying a 5.01% net yield. Cash hasn't offered this in decades. Now, with this, you have to remember, though, that inflation can erode your purchasing power, which is, in fact, a massive risk. Also, in some cases, you may need to hunt around for this type of return. As an example, here's what a big bank is currently offering on their website, nowhere near what you could potentially be getting. The bank is earning all of that profit, essentially. The last thing to keep in mind is that cash is a risk-free asset historically, which means that it should produce suboptimal returns relative to other assets where you're taking risk. Risk and return are always related. If you don't take any risk, you shouldn't expect a higher return over a long period of time. By the way, if we haven't met, my name is Steve Willems. I'm a wealth advisor here with the Willems Wealth Planning Group out here in BC. We started this channel to help you plan for your own retirement. I help you think about how to plan and arrange your investments, your income streams, and ideally have you pay less tax in the process. Now, let's look at some of those bigger retirement portfolio implications based on this kind of immediate assessment. First is rebalancing. You might need to consider some portfolio adjustments given what interest rates have done. Now, remember, we're not in the business of timing the market. The goal is alignment with your long-term strategy. So you want to look at what's moved beyond its target. If anything is meaningfully off target, it should mean that you're taking more risk than you originally planned, or from what your plan actually requires you to take. Up next, cash flow planning. And because the yield on cash or cash-like holdings has risen, it can make it easier to generate the cash flow that you need in retirement, perhaps without needing to sell assets as early. Using the bucket strategy to keep cash sidelined for short-term use can now be done way more profitably than before. Now, before I cover the last three long-term implications, if you're finding all of this a bit much and want some help looking through your situation to see if there are any gaps or missed opportunities, every week we set aside a few hours to help folks who have their own questions. So if you'd like to grab one of those time slots, I'll just put a link in the description below. Now, back at it. Item number 3, annuity rates. Higher interest rates generally lead to better annuity rates. What are annuities? Annuities are essentially guaranteed income streams offered by insurance companies. You dump a bunch of cash to them and they take that cash, they invest it, and they give you back guaranteed income for a specified amount of time, often the rest of your life. Now, these tools can be beneficial for those considering converting a part of their retirement savings into that type of guaranteed income stream. The rates were so abysmal for the last 15 years that this really wasn't commonly seen as a very attractive option, but this is starting to change, especially with more conservative investors. Loan considerations. If you've taken a loan against the value of your home in order to stay in it through your retirement, maybe a HELOC or a reverse mortgage, this can have a significant effect as these interest rates also adjust up. It could mean potentially needing to downsize sooner than you might have originally planned on, as the interest is going to accrue much, much quicker. Up next, opportunity cost. So while interest rates are rising, it might make safer assets like term deposits or high interest savings seem more appealing. There's an opportunity cost, however, to shifting away from your riskier or more growth-oriented holdings. Over the long term, cash struggles to keep pace with inflation, while other assets further up the risk curve or the risk ladder tend to produce what we would call risk premiums, aka rewards of higher returns for baby steps of additional risk. So what might seem like a wash on a return basis in the short term could lead to vastly different outcomes over longer periods of time. Now, there's obviously a psychological aspect to this as well. It's entirely natural to feel uneasy during market fluctuations. The author, Morgan Housel, best-selling author of the book, The Psychology of Money, he had a great tweet recently where he said, every past market decline looks like an opportunity and every future decline looks like a risk. So what can you do now? Number one, you should reassess your fixed income holdings. You want to review your bond portfolio, the safe part of your financial portfolio. Particularly, you want to look at what's called the duration and the type of bonds that you hold. If most of your fixed income assets are in long duration or lower quality bonds, you may be at a higher risk in a rising rate environment. Here, you just want to take another look at it. Consider maybe diversifying into shorter duration or higher quality bonds to mitigate some of that risk. You want to assess your risk tolerance, consult with your financial advisor for personalized strategies, and certainly stay informed, but try to still kind of ignore the day-to-day noise. Up next, realize that doing nothing isn't doing nothing. Sometimes the best action is in fact inaction. If you've built a diversified long-term portfolio that's aligned with your retirement goals, then not reacting hastily to interest rate changes could be your best course of action. However, this should be a conscious choice following a thorough review. Third, what you're going to want to do is you want to rerun your financial plan or your retirement plan. This period of rising interest rates serves as a really important moment to revisit and potentially recalibrate your financial plan. With assets reacting differently to rate changes and spending habits possibly also adjusting, it's crucial to re-examine your long-term projections. If your portfolio value has reduced or your expenses have increased, we would recommend going through a series of stress tests as well on your financial plan. These tests should model various scenarios, hopefully giving you the confidence that you can sustain your desired lifestyle under different types of circumstances. Stress tests can include models that account for lower portfolio performance, increased inflation, maybe even unexpected major expenses. These tests help provide a more holistic picture of your financial resiliency, confirming that you have enough assets to confidently maintain your spending, even in a less favorable financial landscape. This can offer peace of mind that is, quite frankly, invaluable. It's not about just weathering the storm, just trying to survive. It's about doing so with confidence so that you know you'll get to where you're wanting to go. So what's your plan? Now's the time to make sure that you're well set up. You don't necessarily need to make a drastic change, but you absolutely want to confirm that you're positioned well, given all the changes that are going on. That's it for now. Thanks for joining me. If you found this video helpful, consider liking or subscribing for more valuable insights on retirement-specific ideas. I'll see you in the next video.